Gold above 5,000. Silver at 77 after crashing from 121. Shanghai trading at a premium while Western futures pretend everything is normal. And everyone is asking the wrong question. Is this a bubble? Is this mania? Are we at peak gold, peak silver? No. What you are witnessing is not a speculative blow-off. It is the visible fracture of a currency system that has been cracking since 1971. The price of metals is not screaming euphoria. It is whispering warning. This is not about getting rich. This is about understanding what happens when debt, debasement, and denial collide. The ones who understand the difference between a bull run and a currency reset are not celebrating. They are preparing. Hey, James here. This is Noble Metals. If you're new here, subscribe and share your thoughts in the comment section and tell me where you're from. But understand this clearly. I am not asking you to trust me. I am asking you to verify. Check the COMEX reports. Read the COT data. Look into the JP Morgan settlement history. Pull the numbers yourself. The establishment, the banks, mainstream media, and institutions benefit when people do not examine primary data. Ignorance protects the status quo. Transparency challenges it. The ones who stay on this channel are the skeptical ones who actually look at the reports. Because once you examine the numbers directly, the pattern becomes difficult to ignore. Paragraph 1. Alright, so gold 5,043, and everyone's asking whether we are at peak gold, peak silver, some kind of irrational bubble, or mania phase. The short answer is no. What we are seeing is a symptom of a sick currency system breaking down first incrementally and then exponentially. A bubble is driven by crowd euphoria. This move is being driven by structural distrust. A bubble invites retail frenzy. This move is happening while ETF participation lags and central banks quietly accumulate. The difference matters. Because when price rises due to speculation, it collapses when enthusiasm fades. But when price rises because confidence in paper assets erodes, the driver is not greed, it is preservation. That shift changes everything about how you interpret the charts. Paragraph 3. Let's look at the current structure. Silver Western spot, 77. Futures, 77. Shanghai spot, 86. Futures, 88. Holding a $9 premium. Gold Western spot, 5,043. Silver crashed from 121 down to current levels, while gold holds above 5,000 after a historic weekly close. These are not random figures. Exchange data is continuously updated, publicly posted, and fully verifiable. The divergence between East and West pricing shows something deeper than volatility. It shows physical demand willing to pay premiums while paper contracts dictate headline price. That gap tells a story about supply, settlement, and confidence in delivery mechanisms. Paragraph 4. Here is what most people are missing. Gold and silver are not signaling mania in metals. They are signaling dysfunction in global currencies and sovereign debt markets. That is more serious than a tech bubble or a housing mispricing event. Gold has steadily outperformed risk assets through multiple asset bubbles. History shows that when currencies weaken structurally, hard assets eventually reflect that reality. We have moved from incremental rises in metals to an exponential questioning of the entire monetary structure. Since 1971, debt expansion has accelerated beyond productive growth. Monetizing that debt through currency creation seemed manageable at first. Over time, it became dependency. Paragraph 5. The gold-silver ratio currently sits near 65:1. Historically, it hovered closer to 15:1. COMEX vault ratios, mining ratios, LBMA vault data, and above-ground supply comparisons all show different distortions depending on the metric used. Physical metrics show silver appearing undervalued relative to gold by multiples depending on the measurement framework. That spread either implies a permanent revaluation underway or one of the largest structural arbitrage imbalances in commodity markets. Ratios do not guarantee reversion, but when multiple supply indicators align, they deserve attention. Paragraph 6. There are analysts with documented track records calling for significantly higher silver prices despite current volatility. Past forecasts for gold milestones were dismissed before being reached. Now projections of triple-digit silver are circulating again. Forecasts are not guarantees, but track records matter. Pattern recognition matter. When someone has repeatedly identified inflection points correctly while consensus doubted them, it warrants examination rather than dismissal. Still, prudence requires acknowledging that projections remain probabilistic, not certain. Paragraph 7. Commitment of traders' data shows managed money positioning on the long side evaporating to levels not seen since early 2024. Historically, extreme positioning has sometimes acted as a contrary indicator. When institutional traders lean heavily in one direction, reversals often follow. The CFTC releases this data weekly. It is free and public. Anyone can analyze the breakdowns. When speculative enthusiasm fades while price remains structurally elevated, it suggests underlying demand may not be purely speculative. Paragraph 8. Physical silver demand remains strong despite price swings. Stockpiles on major Asian exchanges have declined sharply over multi-year periods. Supply deficits have accumulated for consecutive years. Roughly 70% of silver production comes as a byproduct of other mining operations. That means higher silver prices alone do not automatically incentivize new primary production. Structural supply rigidity combined with rising industrial demand creates tension beneath the surface that paper price movements sometimes mask temporarily. Paragraph 9. Silver's industrial role has expanded into electronics, solar, military technologies, and artificial intelligence infrastructure. When governments classify materials as strategically important, supply security begins to override price sensitivity. Export controls and stockpiling policies can further tighten available supply. When geopolitical considerations intersect with commodity markets, volatility increases because economic logic is no longer the sole driver. Paragraph 10. Gold increasingly functions as monetary refuge as trust in fiat currencies erodes. Since 1971, fiscal expansion has exceeded sustainable boundaries across political administrations. Central banks intervened repeatedly to stabilize markets, reinforcing moral hazard. The assumption that liquidity can always be created to offset instability encouraged greater leverage. Over time, this dynamic reduces confidence in the purchasing power of currency units. Paragraph 11. This is not crowd euphoria in metals. Retail allocations to gold remain relatively small. ETF holdings have not fully reflected the magnitude of price appreciation. Central banks have been significant accumulators. When official institutions accumulate quietly while retail participation lags, it differs from late-cycle speculative frenzy. Wealth preservation strategies focus on maintaining purchasing power, not maximizing short-term returns. Paragraph 12. That does not eliminate risk. Gold above 5,000 can correct sharply. Silver at 77 has technical resistance overhead. Forecasts of 180 silver are projections, not certainties. Historical ratios may not revert. Paper market mechanisms have historically absorbed delivery pressure through rollovers and settlements. Manipulation claims aside, volatility remains inherent. Balanced analysis requires acknowledging both bullish and bearish scenarios. Paragraph 13. The broader issue is policymakers facing impossible trade-offs. Protect the bond market and risk currency debasement. Protect the currency and risk economic contraction. Debt-based systems rely on continued liquidity. Allowing rates to rise aggressively strengthens currency temporarily but pressures exports and growth. Choosing liquidity often weakens purchasing power gradually before potential acceleration. Paragraph 14. Gold at 5,000 is not the core problem. The core issue is declining confidence in fiat stability. Currency systems tend to erode slowly before inflection points accelerate change. When trust diminishes incrementally, markets adjust quietly. When realization spreads more broadly, repricing can become rapid. Metals do not create instability. They reflect it. Paragraph 15. Bottom line. Verify the gold-silver ratio against historical and physical metrics. Examine COP positioning. Review stockpile data. Observe ETF holdings versus price action. Watch central bank accumulation trends. Understand the difference between speculation and preservation. Recognize that metals rising may represent currency weakness rather than metal strength. Invest with logic, not hype. Monitor whether physical demand eventually forces structural pricing shifts or whether paper markets continue containing volatility. The future path is uncertain, but the data is public. Study it carefully. I'm not here to build a cult of followers. I'm here to build a community of thinkers. At Noble Metals, I provide the raw data, but I want you to bring the hard questions. We live in an era where debt is sold as wealth and clicks are sold as value. Don't just take my word for it. I encourage you to be a skeptic. Check my sources, challenge the mainstream narrative, and verify every claim I make, because at the end of the day, A truth you've discovered for yourself is far more valuable than any hype or financial trend. Real gold is rare, but real truth is rare. Let's find it together. This is Noble Metals. I'll see you in the next one. Stay skeptical, stay informed.